Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really happy to have with me once again John Rubino, who runs the popular financial website dollarcollapse.com. And, well, he's a co-author with James Turk of The Collapse of the Dollar and How to Profit from It, probably the best-selling book, I would guess, that John has been involved with. But he's written a number of others called, one is Clean Money, Picking Winners in the Green Tech Boom, and that would really be a topic I'd like to talk to John about sometime, perhaps. How to Profit from the Coming Real Estate Bust, and Main Street, not Wall Street. A number of books John's written, and he also writes right now. He contributes to the CFA magazine. He's written in the past for TheStreet.com, Individual Investor, Online Investor, Consumer and Consumer Digest, among many other publications. So it's really good to have you back. John, thanks for joining me today.
Hi, Jay. Good to be back.
Always good to talk to you and get your insights. And the hot topic of the moment, of course, is Greece. Where is this thing going to go, John? How will it be resolved, or will it even eventually be resolved?
Well, someday it has to be resolved, right? It can't go on forever, but it has been going on since at least 2011. I went back through things that have appeared on dollarcollapse.com about Greece, and even back then, it was this huge incipient crisis. And it's gone out and in of the headlines ever since. And it looks like it might, this time around, be finally resolved one way or the other, but it's still not clear what's going to happen because they're still negotiating a bailout. What happened over the weekend was that talks broke down one more time, and the Greeks have now defaulted on a debt payment to the IMF, and they've closed their banks. So we basically have capital controls in place in Greece now. So what that means is that we've taken a huge step towards something. Either Greece leaves the Eurozone, goes back to the drachma, and kind of resets the clock to the 1990s, or the Eurozone caves and allows Greece to have some money in the short run to pay its bills without having to cut what the Eurozone thinks is extremely generous pension plans. Mm-hmm. And so that's not a long-term fix. That means Greece will continue to spend more than it takes in and pile up debt, and another crisis will happen at some point in the future, but it gets us through today, and I think that's as much as you can hope with today's financial world. You can't fix this without a gigantic crisis. Whether we're talking about the U.S. or Japan or the Eurozone or any specific Eurozone country, none of this is fixable because we borrowed way too much money to get out of this painlessly. So all the guys in charge now can really hope for is to get through the next election cycle intact. And so that's probably what it's going to come down to. Either they do a deal that puts the resolution off for another year, or they just let it fall apart today and get it over with. But I think the fact that we got to the point of capital controls is pretty instructive here, because that means these guys are fairly serious. They're willing to endure some pain and some uncertainty without caving. Mm-hmm. And so, go ahead.
Yeah, I was just going to say the political pain must have reached some sort of a threshold to allow this the current government in and to really insist on what's going on. There must be enough pain out there now with what the Euroland is exacting on the Greek people to allow this politically this hard stance to take place, right?
Well, it's important in the political sphere to understand what debt does. When you've borrowed too much money, your country becomes ungovernable. Mm-hmm. And there aren't any politically acceptable options at some point, and we haven't hit that yet in the U.S. We came close in 2008, 2009 when the government spent trillions and trillions of dollars to bail out the big banks, who the guys in charge then cut themselves record bonuses that next year. Now that politically could have been a catastrophe for the guys in charge, but somehow they got through it. Somehow we let them stay in office despite basically handing several trillion of our dollars to Goldman Sachs and JP Morgan Chase, with no strings attached. But in Europe right now, the guys in charge of Greece, for instance, got elected on a platform of no more austerity. So for them to take a deal that requires austerity from the Eurozone means they get kicked out of office and probably replaced by some kind of radical right-wing party that will cause turmoil in a different kind of way, but turmoil nonetheless. And for the people running the Eurozone to cave on Greece means basically that they have to hand a lot of German money to the Greeks. And that's probably politically unpalatable and maybe completely unsustainable for the guys in charge of Germany. So there's no way out of this without regime change in the next election for a lot of these guys. And that's what they're looking at. They're trying to figure out how to get reelected. And there's no clear way. There's no guarantee right now, no matter what you choose, that it's going to work for you in the next election. And that's why they're dithering, because they don't know what the safest route to reelection is. And there's nothing at all that's guaranteed. I will say one thing, though. The fact that Greece has actually closed its banks, has actually locked people's money into their bank accounts and not allowed them to take it out, is very, very important for the rest of the Eurozone, because now everybody's looking around thinking, well, if that could happen to Greece, who's next? So if you had money in an Italian bank account, would you leave it there this week? Or would you be taking it out and sending it to Germany or Switzerland or someplace like that, even if you have to take negative interest rates? Mm-hmm. At least it's going to stay in euros and not be converted to lira at some point in the not too distant future. Mm-hmm. So I think the big risk now, no matter what happens with Greece, one way or the other, the big risk is that the contagion, the lack of confidence, spreads to the rest of the Eurozone periphery. And that investors and savers lose faith in Spanish banks and Italian banks and Portuguese banks, and that spreads to the point where the numbers are just too big to fix. Greece you could buy all of Greece for what the European Central Bank spends on quantitative easing for a couple of years. Mm-hmm. Well, you can't do that with Italy. We're up in trillions of euros at that point, and so it becomes impossible to manage if it spreads beyond Greece. And that's, I think, what they're really worried about. They don't want a widespread contagion to shake the peripheral banking system across the board, because there's no fix for that. The Eurozone really will spin out of control. If Italy finds itself in the same boat as Greece a year from now, it's game over for the Eurozone. Yeah. And, it's not clear that's avoidable. It might be something that has to happen because of the fatal flaws inherent in the structure of the common currency, and maybe you just can't fix it starting from here. But one possible fix is basically converging into a United States of Europe with one central government and one central budget and one military and all the rest. Of course, that means Germany's in charge of Europe. So a lot of Europeans don't like that idea either, and I'm sure a lot of Germans don't like it themselves, because that means being responsible for Italy's debts. Yeah. And who in their right mind wants to do that? And so it's not clear how this works out, except that while we're trying to figure it out, we as a global financial system continue to accumulate more and more debt. Debt as a percent of GDP continues to go up in the developed world. And it was already unsustainably high in 1999. So yes. It's gone up continuously since then. And so the eventual resolution of this, how much pain we have to take in order to get back to a sustainable, manageable financial system grows daily. And so we're not saving ourselves in any meaningful way by pushing this stuff off into the future, because we continue to borrow money, and the eventual crisis is going to be that much worse. And so that's exactly right. That's what we've been doing, of course, to a greater extent. I think faster and faster now since 2008, 2009, and the pathology is not growing in a straight line, in my view, but is growing almost exponentially. But John, just quickly, who would then do you think would be hurt or helped most in Greece, and then who would be hurt or helped most in Euroland outside of Greece if Greece left the Union? The immediate victims of a Grexit, Greece going back to the drachma, would be the people who still have euro-denominated bank accounts in Greece, mm-hmm. because they've lost half their money. To go back to the drachma and have any chance of working, you got to devalue the drachma dramatically versus the euro. So let's say you take a 50% haircut on your bank account. Then that means your savings partially evaporated. So the people who worked hard and put away some money instead of spending it, they're the victims of this. And that's the first set of victims. And the second set, in the short run, would be the businesses that those people who have those drachma bank accounts would have frequented. If you lose half your money in your bank account, you're not going to go out to eat very often, and you're not going to buy new toys and take vacations. And so those companies suffer to the extent that the population of the country gets poorer. Mm-hmm. So Greece gets poorer in the short run. Now the question is, does a cheap currency make them this tourism magnet for the whole world? All of us are going to want to go and hang out on Greek beaches and spend next to nothing because the drachma is so cheap. And it could be that they get this tsunami of tourist money coming in in years 2, 3, and 4, and that saves them, so that they return to not exactly a balanced budget. I think that's culturally impossible for Greece, but a deficit that can be managed for the next decade, let's say, before it blows up again. So they could go back to that, and that would be, in Mediterranean Europe terms, a success story. So that could happen. Now, the Europeans, the reason that this current Greek crisis is different from the one of 2011 is that back then, big commercial banks owned all that Greek debt. And so for Greek to have defaulted back then the Deutsche Bank and Societe Generale and the other big European banks would have had to take huge write-downs, and they would have become unstable and maybe insolvent, and you would have had a banking crisis. Well, in the ensuing 4 years, the Eurozone has moved all of that Greek debt onto the balance sheets of the central banks. So the European Central Bank and the IMF basically own all the debt that's in question right now. So they take a hit if Greece defaults, but it's really taxpayers who take the hit. It's not the big commercial banks. And, from the point of view of these governments that are run by these commercial banks, this is much, much preferable because you kind of spread it out over the taxpayers of the country and the holders of euros when you have to create new euros to cover the deficit. The value of the euro goes down. So you inflate away your debts in that way, which is relatively painless for governments and for the big banks. So that Europe wouldn't suffer immediately from a Greek default in any kind of meaningful way because they'll print whatever they need to cover whatever contingencies arise. The big risk for Europe is that we all start looking around for who's next. If Greece leaves, then why can't Italy leave? Because they're in almost as bad a shape as Greece financially. And that is a much, much harder problem for the Eurozone to solve. So you take one step down the road of dissolution if Greece leaves.
Yeah,
well, that's what terrifies them.
And that's that terrifies the central banks, I suppose, and probably explains why the central banks are seem to be trying really hard to hold this thing together, I suppose. But very, very interesting. Well, I have to wonder, to what extent Putin is, the Greek government seems to be listening to Vladimir Putin, who would like to put his pipeline through Greece. Do you think that the Greeks are just perhaps using him as a posturing tool against Euroland? Is a leveraging?
That's probably part of the equation back then. They probably thought that cozying up to Russia would light a fire under the IMF and the ECB and get them a better deal. And it didn't work. But should Greece leave the Eurozone, there's probably no reason why they can't do trade deals with Russia. They're going to need money. They're going to be in turmoil. And somebody with a few billion euros to hand them will probably be their friend, no matter who it is. And so, you could easily see Russia take advantage of this. And you know what? That's what NATO deserves, in my opinion. When you start with the Ukraine just recently, where we tried to fold the Ukraine, which is right on Russia's border and has a naval base that Russia needs. We tried to fold them into NATO, which is to Russianize a hostile military alliance. Sure. And so I think from Putin's point of view, doing trade deals with Greece would not nearly be as extreme a behavior as what we did with Ukraine. And it would also be a little bit of poetic justice. Mm-hmm. So, yeah, it wouldn't be a surprise to see it happen. But I don't think it would, I don't think in the long run it would be that big of a deal, because trade flows are, that's a force for peace most of the time.
Sure.
And to the extent that you've got a pipeline running through a country, you don't want to bomb that country, and to the extent that somebody's got a pipeline running through your country, you don't want to antagonize the guys sending natural gas or whatever through your pipeline and paying you fees for it. Mm-hmm. So trade deals with Russia, even when there are some strings attached and maybe a little too much dependency in the future, I think on balance are still probably a good thing, and so not that big of a deal in the scheme of things. The U.S.-Russian relations are the really scary thing right now. I think the Europeans left to themselves would accommodate Russia, and Russia would accommodate Europe, and that would be more or less okay. So the U.S. is kind of the really bellicose player. I
couldn't agree with you more about that, John. That's certainly something we talk to Daniel McAdams, the Ron Paul Institute for Peace and Prosperity, on a regular basis. And changing topics a little bit here, you wrote about the housing recovery. You're suggesting the numbers, the strong numbers that we saw recently, are probably not what they're cracked up to be, or that they are good, but they're just because people are really fearful of a rising interest rate, rising mortgage rates, so they're hurrying off to try to lock in some financing now and get their deals done now. Is that the basically in a nutshell what you were saying on your 23rd of June article titled Housing Recovery? Yeah,
the housing numbers have gotten much better lately, but it's come at the same time that interest rates have been going up, so mortgages have been getting more expensive. And historically, those two things kind of go together for a while. For instance, if the mortgage rates are going up, which they have so far this year, they've gone from mid 3% to low 4% for a 30-year fixed-rate mortgage. And you're a potential buyer, that's scary to you because it's raising the cost of these houses that you thought you might put an offer in, but you were dithering about. So it lights a fire under you, and you think, all right, let me lock in 4.1% then before it goes to 5%. And then you make an offer on a house. So a house gets sold. Same thing if you're a seller. You've been holding out for the best possible price, but you see mortgage rates going up, which is causing the number of qualified buyers for your house at your ideal price to shrink. And so that makes you nervous. So maybe you cut your price a little bit and get the deal done. So you see a burst of activity when interest rates start to go up. But it's not necessarily sustainable if all it's doing is taking future sales and moving them to the current month or whatever. Yeah.
It's like what we did with when the government encourages to trade in our old cars or junkers for new cars and stuff, right? So
that's exactly really, what's happening in the auto market in the last few years. We are stretching out the maturity of auto loans and lending money to people who didn't used to qualify. So we're selling a lot of cars, but we're doing it at the cost of lower sales in the future, because if you've got a 7-year car loan, you're not going to be trading in that car anytime soon because you are underwater from day one.
Yeah.
And it takes you years of payments to get back to where you could sell your car for enough to cover the loan. And until that happens, you're not going to have an incentive to sell that car because you're instantly down a few $1,000s. So we're locking a lot of people into basically car mortgages.
Well, it seems to me, John, what we're doing is essentially what the Greeks are doing. We're kicking the can down the road. It's just another. But the advantage that the United States has, and why I think we're so involved in so many wars, is to keep the existing petrodollar system in place. The Greeks can't print money like we can. And do things like we can. Not even the European Union is able so easily to create money, although I guess they're doing it now more so. So we're really back to the same problem, aren't we? The whole world has gotten accustomed to living beyond its means because of this thing called debt. It's consuming today what you have not yet earned to consume.
Yeah. I mean, and we've been doing this for 30 years now. We've been borrowing money from our grandkids in order to have fun today. basically.
Right. And it's growing, and it's not a straight line thing. It seems to me something that's growing faster and faster. You have to keep this ball rolling faster in order to stand still almost in your living standards, it seems. Because your debt is even with these low interest rates, your debt is starting to consume so much of your income.
Yeah. So two things about that. One is that if interest rates were to go back up, that would be Armageddon for the developed world, because so much debt out there right now is variable rate in one way or another. Either it's very short term, which means you have to roll it over, or it bounces around based on the prime rate or LIBOR or something else. And let interest rates go up and your interest costs go up, which means you can spend less on other things, which means growth slows down, which means the governments of the world take in less tax revenue and see their interest costs go up and their budgets explode. So you get all of these really bad effects from interest rates going up in a variable rate world, which is what we have now. And the other thing is that as we pile on more and more debt, we're having to go to greater and greater lengths to hide the true size of that debt load. And it used to be 50 years ago, you had debt that you could point to, and it was actual loans, and that was the amount of debt that the country had. Well, now we've got unfunded liabilities of Social Security and Medicare, which dwarf the government debt, it triples it or quadruples it. Yeah. And we've got derivatives at the big banks, which are a form of debt, they're a liability, but they're hidden by the big banks. And the notional value of the derivatives books of the banks today are around $2 quadrillion. It's enough to vaporize the global financial system if they start to go bad. Yeah. And those things aren't counted as debt. So when we talk about debt, even when we use the true actual, conventional number, it's still big. It's still scary, but it's maybe 1/8 of the true number, and we're lying about the rest. So
we really are lying about the rest, and I'd be lying if we kept going on here because we're running out of time. We got 1 minute left. Time is sort of like money, and it's limited, or it should be limited anyway. Money should be limited. But John, there's so much more to talk to you about. You wrote an article, "Is this gold's long-awaited killer app?" And that had to do with BitGold. We had the James Turk and your buddy James Turk and also Roy Sabag last week with us. I love this BitGold story. 30 seconds, give me your idea about BitGold. What are your thoughts about it?
Well, I think the holy grail for sound money advocates and gold bugs in particular is spendable gold. Some kind of a gold-based payment system where you can store your cash instead of in fiat currencies that are being depreciated aggressively by their governments in gold, and then spend it. And that's the goal of BitGold. It's trying to create a payment system that does that, and if it works, that lights a fire under the gold price, because you get this. I think we're out of time, but if we
we are basically out of time. But that's what James Turk always wanted to do, and now he's teamed up with Roy Sabag, and it's something that I'm going to be talking about a lot on this show, and I invite you back to talk about it too, because I think it's so important, and I also like this stock a lot. Honestly, I think it has potential. If it can do what PayPal can do, but do it better, then I think it might have a real chance for some big success. And as you suggest, John, possibly light a fire under the gold price. If people, you don't have to be an ideologue. The fact that if this can work better than PayPal and less costly and more efficiently for a payment system, then you don't have to be ideologically locked into it. Everybody should want to use it, I would think. And that's what really turns me on about BitGold. What are your, just real quickly, 30 seconds, 10 seconds.
No, I like that, because you get a positive feedback loop if this works, where you deposit gold in a BitGold account, and then if gold's price goes up, your savings account gets more valuable, which makes it more likely that other people are going to deposit gold, which increases the demand for gold, and you get this feedback loop that could send gold through the roof.
All right. We have to leave it at that, John. Yeah. We have to leave it at that, but we'll be talking some more about that. I want to thank you for being with us today.